Real estate.
real estate
Real estate में
real estate
real estate.
Considering real estate for the purpose of wealth appreciation in India? Do have a look at the facts and figures first. Firstly, there are a lot of ifs and buts associated with real estate in India. Did you know that over the past 10 years, multiple developers in India, including Amrapali, Unitech, Supertech, as well as JP, have taken money from buyers but have failed to deliver upon their commitments and have gone bust? Secondly, let's talk about the returns. If you think that the asset is going to generate returns for you, do think again. Admittedly, real estate has done very well in the past 3 years. But let's have a look at the prices between 2013 to 2018. For all of these years, real estate performed negatively. As a look at the real estate prices between 2013 to 2018, the prices across India went from an 8% annualized return to minus 1%. In fact, if you look at the long-term 10-year returns all over India, they come out to be a measly 6.5% on an average. If you compare this with other asset classes, here are the results. 6.75% annualized return over the long term in property versus about 13.8% annualized return in equity. That is purely from Sensex, and if you add mid caps and small caps, you're looking at 15% and 20% annualized returns. 6.7% across gold and 8.4% across the BSE India Bond Index. And if you think that you're going to earn from the rental income as well, think again. On an average, the regular residential real estate generates a 2% annualized rental over the property cost. So if you add a 6.75 annualized long-term return with a 2% rental income, you're left with an 8.75% annualized. Here is a comparison between two investors who are investing in real estate versus equity. In the first case over here, the investor is investing nearly 50%, that is half of their net worth, in residential real estate versus just about 4.5% into equity. Compare this to the other investor who is investing about 27% of the net worth in property versus about 37% in equity. Here is a look at the post-tax portfolio returns, 6.9% in the high real estate property case and 10.3% in the higher equity case. Let's talk about the wealth multiples as well. In the first case, wealth is multiplied by 28 times over the lifetime. In the second case, with higher equity allocation, the wealth has multiplied by 135 times over the lifetime, which makes more financial sense. The third and very important factor to consider is liquidity. So remember, when you are investing in real estate, you're likely to invest in a property which is valued in crores. Think about an average investor who is buying a property for 1 crore. That person is likely to take up a loan of about 70 lakhs from a bank, and over the course of the next 20 years, at an average rate of 8.5%, will end up paying 1.5 crore rupees in principal as well as interest over to the bank. Also, it's not a very easy class to liquidate. If you have to liquidate, you're looking for a buyer. The buyer will also negotiate for a loan. You have to pay over and added ancillary costs, including stamp duty, registration charges, property maintenance as well as repair charges, and you're looking at a lot of overheads. So the liquidation of the property can easily take up to more than 6 months. Let's look at what the smart investors are doing in India. Here's a look at Bengaluru-based Mr. and Mrs. Kumar, age 70 as well as 62. Back in 2005, these investors were only investing largely in real estate, with about 85% of their assets invested into real estate and just about 15% into debt. Then they met a financial advisor, started reducing some of their real estate portions, and are investing 56% in real estate in 2010 and started investing in equity at about 12%. Cut to now, in 2023, they have half of their assets invested in equity with absolutely 0% real estate exposure. Now that they are retired, they are leading a much more fulfilled as well as free retired life, fulfilling all of their financial goals, including having multiple international trips. Here's a smart financial suggestion. If you are at an early age as well as at an early stage in your career, do not consider investing a heavy amount in real estate, as this could tie you up and could stop you from taking up some good opportunities in your life. Later on in your career, you might get multiple career opportunities which may require you to go outside of your city as well as outside of your country. Having a large portion of your assets tied up in an illiquid asset class like real estate and a large portion of your incomes going into servicing loans can make it very difficult for you to take up good career opportunities. having a very large portion of your net worth invested into real estate is not a very good idea. Instead, having a higher percentage invested into equity over the long term can get you much better post-taxation wealth appreciation. This is Shalini Gera signing off. Thank you very much. Bye.